Good afternoon, everyone. This is Carrie Sparks with Pioneer Title, your Arizona title gal. Every Tuesday, we do a piece with Brian Reeves over at Barrett Financial. It's called Ask the Underwriter. And so I'm excited to talk about we picked a topic that I think is very timely at this moment. But if you'd like to get a hold of me, I'm never too busy to work with you. My phone number is 602-715-5704. Brian, you want to give your contact information, please?
Yes, it's Brian Reeve with Barrett Financial. Phone number is 602-741-4801. My NMLS number is 694300.
I have a couple things that I wanted to make sure that everybody knew about. I have 3 events that are coming up. First and foremost, the Cromford Report, which I kind of almost take as the gospel of what's going on in the local real estate market. We have an event coming up. It will be held on Zoom. It will not be live, with Tina Tambor. It's on August 25th. And if you'd like to message me or give me a call or email, I'm happy to send you the link to sign up. I believe there's only 100 spots for this event, so I'm pretty sure that this will be sold out. I also have a online networking event, just talking about how to work in our present state, and then also a staging class. And it's a little bit more complex than you'd normally think with staging. And so I've got a local staging company that's going to go through some of that with realtors and, of course, loan officers if you'd like to join. And it's fascinating. I've spoken to the company, so I'm excited to get a date on the calendar very shortly. But the topic of today is alternative financing. And not everybody is a W-2'd person. And so I was going to ask the underwriter here about alternative financing and bake state programs. Take it away.
Sure, thanks. So, I think a lot of us that have been in the industry a long time, we saw the birth of Alt-A, right? The Countrywide Fast and Easies, the Ninas, the Sivas, the CISAs, all of that stuff that existed. And after the housing meltdown, we really saw just all of those programs just dissipate. There's really no desire for them or appetite for them in the secondary market. Pretty much Alt-A was killed for the most part, and everything was fully qualified, safe harbor, QM, 45 DTI, really cracked back on qualifying parameters for primary residences. There's been some alternate programs that don't necessarily fall into those parameters that have been getting a lot of attention. They dialed back a little bit prior to COVID because of the appetite in the secondary market, seeing where things were going with the forbearance and all that. But we're really starting to see some return of them. One of the more popular ones out there is what we call as a DSCR. And a DSCR is basically it is a purchase of an investment property. You can be a first-time investor or a previous investor, but they really want to see that the property cash flows. And that's really what they're using for qualifying a customer. They're not looking at the income or asset documentation. I mean, they are looking at, the money that you have to put down on it, but from a debt to income ratio perspective, what they're worried about is that the house cash flows. So if you know what the house is going to rent for in the area, and you've put your 20 to 25% down, and based on what your mortgage payment will be at that interest rate, as long as what you're going to rent the house for, and it covers the mortgage payment, and there's 20% equity or more, the house technically is a standing asset on its own. It's cash flowing itself. It's paying for itself. So it really takes the customer out of the equation, and it really just looks at it from an investment standpoint from an investor. If an investor ever had to take that asset, the asset's covering itself. It's covering its own mortgage payment. It's got its own equity if they needed to resell it, especially in a market where things are hot right now. So most investment properties anyways, if you have really, really good credit, you're looking at putting 15 to 20% down. You're looking at mid 5% interest rates, and you have to qualify from a debt to income perspective. With this, if you can prove that the house is going to basically carry itself and the equity is there. This allows a lot of people to get into investing, especially at a time like this. So those programs are kind of hot right now. You'd have to call me for details on that, but those interest rates, like I did one yesterday, and I think it was high fives, low sixes. So high fives, low sixes for someone that's basically not documenting income and just watching an asset carry itself, and you just having that as extra cash flow is a great opportunity to get into this type of financing.
It did disappear during the beginning of COVID, though, because I remember when we were talking back in March and April, how all the non-conforming programs pretty much vaporized overnight.
So we had a lot of lenders that were heavy in it. They called it the NONI. So you had some of the no income, no asset, NONI, DSCRs. You've had debt service recoveries. Basically, is what it stands for. But basically, all those just took off, and nobody was kind of scared what's going to happen with it, with the forbearance and unemployment and all of that happened with Corona and the liquidity. But we're starting to see a lot back. Like I have 3 or 4 investors that are doing them right now, and
that shows a lot of return confidence to the market, though, doesn't it?
Well, we're starting to see it stabilize out. In fact, if you look at the Mortgage News Daily, there's more. Not the sky is falling in doom and gloom. It's more positive news that you're seeing on an average from even Mortgage News Daily about, the slowing of delinquencies and the stronger housing markets and appraised values and purchase prices. And there's a lot of things that are actually going the opposite of what people were dictating. So another product that's kind of popular right now is bank statement programs. So bank statement programs, these are for self-employed customers that basically don't make any income on their taxes. You have a lot of people that write off a lot of stuff on their taxes, and they're self-employed, and they're just like, this is the only income I have. I go to the bank, and the bank tells me I need a 2-year employment history. But then after they look at my tax returns, now I'm stuck with the fact that I may have to wait another 2 years before I qualify. But I'm not going to quit being self-employed. This still works for me and I can still pay my bills. I just don't report to the IRS necessarily that I make all of this money, right? So what we do is we have a bank statement programs that are 12 and 24 months. And the 12 and 24 months, we can basically average what that income is based off of what credits and debits and ending balances. We have spreadsheets that will actually calculate what their income is on a cash flow perspective from month to month. And that's the money that we give them towards the down payment. Now, these are heftier down payments still. You're still looking at anywhere from 20 to 30% down. But these programs still exist. And the rates aren't that bad. They're like in the mid fives. So given the fact that, right now rates are a lot lower than that, but given the fact that if you can't establish income, with the exception of with bank statements, this is huge.
Sounds like a really big deal. I mean, can you give your contact information again? So if someone has questions about these and if they qualify, I mean, it's completely possible that somebody who thinks that they don't qualify could actually get into a home in this moment.
Yeah, there's also one other program I failed to mention, Carrie, that a lot of people don't realize exists, but it's out there. So it's called the P&L program. So a lot of times when we have a situation where when we look at tax returns for a self-employed borrower, a P&L never really helps the customer, it only hurts them. So if you have a 2-year tax returns and we're trending whatever your income is, we want to make sure that year-to-date P&L is actually trending in a positive way. If it starts trending in a negative way, then basically that's going to basically negate all of your income from the prior 2 years because we're showing that you're trending down. So that's something that when underwriters are looking for P&Ls, that's what they're looking for. They want to make sure that income's trending in a positive manner. If they ask for an audited P&L, it's expensive and nobody gets those anymore. or even asks to get those. You can spend $6,000-7,000 on an audited P&L. So the P&Ls really give no weight. However, there's a program out there that will qualify you off of a 1-year P&L with no tax returns.
Wow.
So these programs do exist. There is stuff out there and options for customers that don't necessarily fit the box when it comes to terms of income, and there's more than one way to get deals accomplished without just qualifying income perspective wise.
And so I know you usually put your business card down below for your contact information, but just one more time, what's your phone number?
602-741-4801, and my NMLS is 694300.
Seems like you've got that memorized.
It's only 6 digits. Well, I had it long enough. So
I appreciate your time every Tuesday, because Ask the Underwriter is actually, I really enjoy this time with you, because there's always so much that you can learn from it. So thank you for watching. I'm Carrie Sparks with Pioneer Title. Again, I'm your Arizona title gal, and I can reach at 602-715-5704. Thank you to all of my customers that have supported me, have supported Pioneer, and just know that we really appreciate you. And if you do not have a relationship with anyone at Pioneer Title, I'd love to be your go-to for title insurance. So everyone have a beautiful evening, and thank you so much for your time. We really appreciate it.